Hey everyone, Richard Norris here, and in today's video I want to share with you how the UK tax system is literally set up to keep you trapped. It's designed and put in place to stop you achieving financial independence. And there's a meme that goes in life that says this: it doesn't matter how much money you make, the only thing that's important is how much money you keep and now the money you keep that you can multiply. Now, the hardest part of this whole equation, if you live in the UK and you're a UK taxpayer, is the system is literally designed to stop you from keeping as much money as you can and also to stop you multiplying it because of the tax system that's in place. It disincentivizes you and I to actually buy properties in the UK if you follow the traditional tax system. However, in today's video, I'm going to break down the granular equations and calculations of how a typical cycle goes, and I'm going to share with you, if you were to just earn £100,000 of gross income, getting taxed at source as a normal employee under pay as you earn, you are going to basically end up investing into one buy-to-let property. Just as an example, if you were to take your net proceeds from the 100k salary and you were to just invest that into one buy-to-let property in the UK, buying in a limited company, right? And this is how everyday people do it, that you're basically going to, over a 10-year period, end up only keeping and making an extra 10,000 on the original 100k salary, right? Now, I know that doesn't make sense right now, and you're probably thinking, how does that even add up? That just doesn't make sense. Why would I do that? But like, just listen to me and go through the video today, because when I go through all of the calculations and I break it down to you on the whiteboard in a second, like, you're really gonna see how this works. Now, it took me a long time, honestly, to go through the calculation and kind of map all of this stuff out. But when I did the calculation, I realized how clever HMRC were and the tax people were, and I realized actually how it's actually not like the everyday thing that people look at, and therefore they understand maybe we're paying a lot of tax, but they don't understand quite how disincentivized we are in the UK and how unfair the UK tax system actually is and how smart HMRC are. So I'm basically going to show you that. I'm going to hold nothing back in this video, and I'm going to show you how the UK tax system has literally, like I say, been put in place to stop you from getting rich and getting you wealthy. And like, honestly, the UK tax system is designed in this way because they don't want you to know this stuff, because let's be honest with each other, like, if they did want you to know this stuff, it would be taught, and financial literacy and financial education would be a big part of what we're taught at schools, but it's not. It's missed out of the education system for this reason. Now, without going into the granular details right now, before we go into that and before we start, if you don't know who I am and you're new to my channel, my name is Richard Norris. I've successfully grown a multi-million-pound property portfolio, and my group of companies does over £200,000 a month. Now, if you're new to my channel, please make sure that you subscribe, hit that notifications bell icon so that you can be notified of any new content that gets released weekly. And then also, if you like this video, please give it a thumbs up and hit that like button. It helps me to basically get more people looking at my work, and I'd really appreciate that as we try to spread the message and help you to achieve financial independence in your life. Now, first thing I'm going to do as well before I go into the calculations is I'm going to apologize for basically my video looks a bit dark here today. The sun in Dubai is not really shining that much, even though there's a nice sunny background. I've got kind of this pillar in the way, and there's not really much I can do about it right now. But basically, I learned from Alex Emozi, who basically is the man who does $100 million offers. He basically says that it's not about the wrapper that's important. The most important thing is the content within the wrapper. So I just wanted to get this content out because I believe it's so valuable for you, and that this content that you take away with you today honestly has the ability to change your life if you really understand this and apply it into your life and make smart moves, right? Because I'm not only going to highlight the problem to you, but at the end of the video I'm going to show you how you can solve the problem, because it's not all doom and gloom, right? Like, most people think that if you go to work, get a good job, earn a good income, and then invest in property, that investing in property may not be the best thing because there's too many taxes, right? And you're right if you do it this way, but I'm going to tell you and show you today at the end of the video, I'm going to tell you how you can basically pay 0% on all of the taxes within your property portfolio if you know what you're doing. And I'm really passionate about that. I have over 700 clients that I mentor, coach, and help, and I have lots of high net worth individuals that we've saved like literally £4 million of taxes on a year just by setting and implementing the systems that we teach. So with that said, and without further ado, let's jump into the system. Let me show you how this works. I'm going to go through the system that show you how you're taxed 5 times on the same money. So let's jump in. Okay, so let's go through the calculation on the whiteboard here. So if we have £100,000 salary, so we're up here to start with, right? £100,000 gross salary. Basically, when you get taxed at source, the taxable income on £100,000 of gross salary as a corporate employee is £87,430 per year. And the reason that it's £87,430 is because you have a tax-free allowance of £12,570 per year. Now, the total tax that you'll pay on the taxable income of £87,430 is £27,432, and then you'll have national insurance contribution to pay as well, which is here of £6,969.30, right? So if you add the taxable income plus your national insurance contributions together, the total tax that you pay as an employee working in the UK earning £100,000 per year is £34,401.30, right? So if you take the £100,000 gross salary and you minus off the £34,401.30, you end up with a net income of £65,598.70. So basically, like the gross taxable income, if you add all of that up together combined, comes to 34.4% as an average. And that's the first tax that you pay in the UK, right? Very straightforward so far, income tax, right? Now, let's say that you were just a little bit financially successful. You're earning £100,000 per year. For most people, that's a really good income. You get taxed at source. Then what you decide to do is, let's just say that out of that £65,000, we're not making an allowance for any of your living costs. I'm just running a hypothetical example here so I can show you how the UK tax system is literally, honestly, just ripping you off. I'm just going to say how it is. But let's say that we keep the 65,000, we keep all of it, and we choose to invest that £65,000, and we choose to buy one buy-to-let property, and we buy it in a traditional way. We buy the property, let's say, for example, I'm from Oxford, so let's say we buy a one-bed flat in Oxford in the southeast of the UK, and we buy the property for £225,000. I'm just going to assume that in a second. I'm going to pop that on here, and we just buy it putting down a 25% deposit, right? We're not doing anything fancy. We're not doing any buy refurbishment, a refinance and repeat process. We just buy a traditional buy-to-let property. We're a busy corporate employee, put down a 25% deposit to make this as simple as possible and to make the point I'm trying to make and for you to be able to follow it, right? So let's say, okay, we buy the property for £225,000, right? So I'm going to put here £225,000 is what we buy the property for, right? Now, if we buy a property for £225,000, the one bed flat in Oxford, and we put down a 25% deposit, the deposit that we'd be putting down would be £56,250, right? So I'll put the deposit in here, £56,250. So you literally take the 225,000 times it by 25%, and that's the deposit that you'd have to put down out of your 65k of earned income. Now, the mortgage on this property therefore would be 75%. So 75% of £225,000 is £168,000, right? £750, right? So this is the mortgage that you take out. Now, we have to pay stamp duty. When we buy a property in the UK, we have to pay the additional stamp duty rate. We're assuming that you own one buy-to-let property in your own name right now as your main residence where you live, and we're buying a second property. So this is the additional stamp duty surcharge at 3%. So 3% of the 225,000 is £6,750 of stamp duty, right? Then what you do is you have to pay your legals and your broker fee, for example. Now, we're just going to assume that the legals on a property purchase like this is £2,000. So if we take the 56,250 and we plus the 6,750 and we add on our £2,000 of legals, the actual total investment on this property works out to be exactly 65k. So you're basically, again, you're using your net earned income from the 100k, which is 65,000, and you take the 65,000, you invest all of that into your buy-to-let property, right? So now, remember, the 65,000 that we've already earned has already been taxed. We made 100,000, the net was 65, we paid 34.4% tax. We've already been taxed on that money once. Now, the same money gets taxed a second time because we have to pay the stamp duty. So what I'm saying here is if we take our £65,598.70 and we minus off the stamp duty of 6,750, we actually left with a net income out of that 100k gross after we've paid all of our taxes to basically buy the property as well, is £58,848.70, right? And I'm calling that tax too. So you paid income tax as on pay as you earn, and you paid stamp duty. On the same money, you paid two taxes, so your 100k became worth 58, right? But we've done the transaction now, right? Now what we do is we decide to rent the property. Now we're going to assume, for the purpose of this hypothetical example, that the rental income is a 5% yield. So 225,000 times 5% will give you an annual rental income of £11,250 of rental income on this property, right? Now, your mortgage interest, we're going to assume that we're buying it in a limited company, and at the time of this recording, as of today, January 23, the mortgage interest rates are around 5%, okay? So we're going to say that if you take the mortgage of £168,750 and you times that by 5%, you're going to end up paying £8,437.50 on your interest-only mortgage payments every year. Now what we're going to assume is we're going to assume that there's no management fee. We're going to assume that you self-manage this, that you don't have a letting agent. Again, we're just doing it in a normal, traditional way. And again, most people at this level, when they're earning like 100K per year and they're getting into property, they usually try and self-manage things in a place where they live because they think that that's the best thing to do, that they're saving money and they can't trust it, like letting agents. As an example, that's usually a fear that they have. So we're going to say that, hey, there's no management fee, you self-manage, we're cool with that. And now the next thing we have to calculate is monthly operating expenses at 10%. Now, what are your monthly operating expenses if you're new to property? Basically, on a normal traditional buy-to-let property, we allow for buildings and contents insurance and any maintenance and wear and tear throughout the year. We basically allow 10% of the gross rental income every year as a contingency fund to cover buildings and contents insurance, our boiler service, our annual PAT testing that we have to do, and just all the general things we have to do as a landlord and the obligations that we have owning a property in the UK as under a traditional buy-to-let mortgage. So 10% of the £11,250 gives us £1,125 as our monthly operating expenses a year. So if we take the £11,250 of gross rental income, we minus off the mortgage interest payments of £8,437.50, and we take away the monthly operating expenses at 10%, which is £1,125, we end up with an annual profit on this property of £1,687.50, right? Now, this is where we pay our third tax. And now I'm always looking at cause and effect. The original money that we invested was 65K from the 100K salary. It got taxed once at income on pay as you earn. It got taxed a second time on stamp duty. And then the money that's made from the original source of the 100K gets taxed a third time, and it gets taxed at corporation tax because we bought it in the limited company. Now, this is 19%. So if we take the £1,687.50, which is our annual profit that we worked out, gross profit, and we times that by 19%, which is the corporation tax rate at the moment in the UK, you're going to end up with a tax bill for that year of just £320.63. So not a lot, but still, that's the third tax that you've just paid on the original source of money that has made you this money. So I'm always attaching it back again to the original source. I know we're making new money now, but still, the original source of money was 100K. You've got to remember that, looking at the cause and effect relationship. So now we've paid tax number 3, right? Now, what I want to do is I want to say that we're going to hold this property for 10 years. And the reason we're going to hold the property for 10 years, we could hold it for 20 years, 30 years. It would probably make more sense to hold it longer with the example I'm showing you. But let's just use a 10-year hold period. The same principles will apply in the calculations. If we're to use this over 10, 20, 30, 40 or 50-year period, the same principles apply. So for the purpose of this, we bought this property, a one-bed apartment in Oxford for $225,000 with a 5% yield, giving us £11,250 of gross rental income a year and holding that for 10 years. So if we take that 10-year period, the rent of £11,250, we're just going to times everything by 10 now. The rent over the 10-year period would be £112,500, right? Now the mortgage interest payments that you would pay, remember, we are paying £8,437.50 in mortgage interest payments here every year. So if we times that by 10, we end up with our mortgage payments over the 10-year period being £84,375, right? Okay. Now remember, we had no management fee, so the management fee remains at nil. And then we have the monthly operating expenses at 10%, which was £1,125 a month from the original calculation up here. Okay, and we times that by 10 over the 10-year period, which gives us a monthly operating expenses over 10 years of £11,250. Now, if we look at this and we look at the gross profit that we make on this property over a 10-year period, what we get is this. We get the 112,500, we minus off the £84,375 in mortgage interest payments. There is no management fee, and then we have the monthly operating expenditure of 11,250. So if we take the 112.5 minus the 84,375 minus the 11,250, you end up with a gross profit over the 10 years for the cash flow of £16,875, right? Now on that £16,875, we're still at the third tax. We have the corporation tax bill to pay at 19%. So we worked out what it was monthly over here. We worked out to be 320, but over the 10-year period, if you take the 16,875 and you times that by 19%, your corporation tax bill is £3,206.25, right? Which again gives you a net profit if you take the 16,875 and you minus off the 3,206.25, the tax that's due, the net profit that you make over that 10-year period from the income, the rental income, net rental income profit would be 13,000, okay, £668.75. That's the net profit that you make. So we've paid three taxes: income tax, stamp duty tax, and then corporation tax on the net rental profit, right, over that 10-year period. The next thing we pay, the fourth tax that we pay in this example, we basically pay either capital gains tax or corporation tax when we sell the asset. And I'm going to say for the purpose of this example that we held the asset for 10 years, then we decided for whatever reason we wanted to exit, we wanted to cash in, we're reaching retirement, and we just decided that was what we were going to do. So we sell the property and we crystallize the gain. Now at that point, if it was in your own name, you pay capital gains tax, so you pay the fourth tax of capital gains tax. But in this scenario, we're just going to pay another lot of corporation tax. So the fourth tax we paid every year. We've been paying corporation tax at 19% on the income. The fourth tax we pay is we pay corporation tax again on the sale at 19%. So no capital gains tax to pay at 28% as a high rate taxpayer. So we've been a little bit savvy. We've done it in a limited company, but still we're taxed a fourth time on the sale at capital growth at 19%. So what I'm saying in this example is if we bought this property for £225,000 and we assumed a 5% capital growth rate every single year, if you did 225,000 times 5% and you did that calculation 10 times to get the compounding effect, you end up with a figure over the 10 years that means that your house becomes worth £366,501. Now, if you want to know how to do that calculation, you do 225,000 times 1.05. It will give you a number. Times 1.05 times 1.05. Do that 10 times on the calculator, you'll get 366,501. It takes into account that compounding effect. Now, what we're going to say here is we've got the 366,501, which is what the property's worth in 10 years. We bought the property for 225,000 on day one. So to get the gross gain, what we do is we take the 366,501, we minus off the £225,000, and we end up with a gross gain of £141,501. That's the gross gain that we've got. That's the growth, that's the gross capital growth that we've experienced over that 10-year period. And that sounds good. But then what happens is we take the 141,501 and the taxman comes along and says, well, you sold this property this year and you made £141,501. So we're going to tax you a fourth time. We're going to give you another 19% corporation tax, right? So at this point, we pay 19% corporation tax of 141,501, which if you do that calculation, it works out to be £26,885.19, right? So that's our fourth tax, either capital gains tax or corporation tax. We bought it in the company, so we pay corporation tax, right? Now, what we have to do here is you have to say, okay, well, the gross gain was 141,501 minus our tax bill that we've worked out up here of 26,885 and 19 pence. If we do 141,501 minus the 26,885 pounds and 19 pence, we end up with 114,615 pound and 81 pence as a net profit, basically. Okay. Now, what we have to do is you have to take the net profit, which was 114,615 pounds and 81, Plus, remember over the 10 years, we've had a rental income profit, which we worked out earlier, of £13,668.75, which means that the total profit on this investment over the 10 years was £128,284.56. So it seems quite profitable at the moment. Not too bad, right? Even though we paid 4 taxes, it's not too bad. But then we have to look at this calculation in a minute, which is where the 5th tax comes in and really hurts us. And then, like, you'll see in a minute that this it all comes together and it doesn't make sense, right? So, and I mean, when it says doesn't make sense, it doesn't make sense in the taxes that we pay, and we see just how kind of almost like screwed over, to be honest, that we're getting, because we get the £128,284.56 of net gain over the 10 years from the sale plus the cash flow, and we have to add on the initial deposit. Remember, the initial deposit would mean that this would be our cash in bank. So the initial deposit that we put into the property on day one, remember, was £56,250. So we take the initial deposit of £56,250 plus our profit of £128,284.56 to work out the cash in the bank after the sale and the taxes. So the cash in the bank at that point, if you do the calculation here, would be £184,534.50. I think that says 56 pence. Should be 56 pence, right? Might be 58 pence, 56 pence. I think it should be 56, right? So you end up with £184,534.56. Then the next tax you have to pay, right, at this point in the calculation, and this is where things really get hit home, right? So out of that £184,000 that we've got in the bank, we have to pay inheritance tax, right? At the end of the life, it comes into our estate, and I'm just saying at this point we die. And you have £325,000 of inheritance tax allowance per person. For this example, I'm saying that you're a married person and you've already used up your £650,000 of inheritance tax allowance on your own home because you paid that down to zero, and it was worth more than £650 because you've been financially successful, right? So at this point, you've got a 40% inheritance tax bill on anything else within your estate, and this cash at the moment is sat in your estate because it's in a bank account because you sold the asset after the 10-year period. So what we do is we have to do the inheritance tax calculation on this, and this is the 5th tax that we pay, which is the IHT. Okay, so what we do is we take the 184,534 and 56 pence, and we times that by 40%, right, to work out what our inheritance tax bill is. So if we take the £184,534.56, which is the cash in bank at the time of death, times by 40% is equal to £73,813 and 82 pence. Run out of space here. £73,813 and 82 pence is the next tax bill that you pay. So if you haven't already been taxed enough 4 times over, now the HMRC come along and say, no, we're going to tax you a 5th time. You're going to give another 40% to us, right? So that's the 5th tax. Now, here's where it all comes together, and it's just about to make a lot of sense. And you're going to see what I'm trying to say here, right? If we take the 184,000, so now what we do is we take the 184,534 and 56 pence, and we minus the tax bill of 73,813 and 82 pence, right? If we do that calculation, which is the cash in bank minus the tax bill at the time of death, you end up with net income of £110,720 and 74 pence in your bank account. Now you've paid all of your 5 taxes, right? You've paid your income tax on day one at 40% high rate taxpayer that blended out to be 34.4%. You paid your second tax, which was tax number 2 was your stamp duty land tax. Number 3 tax was your corporation tax on the income. Number 4 tax was your corporation tax at the time of sale, and which was the capital growth there, and the 5th tax was the inheritance tax. So at this point, we're left with £110,720 and 74 pence in our bank account after paying the 5 taxes, right? Now what we do is we say, well, what was the original sum that we started with? Remember, the original net cash that we started with was just 65,000, right? That's what we invested. So if we take £110,720 and 74 pence and we minus off the £65,000 of the initial investment, that will give us our total profit over that 10-year period. Now the total profit, if you do that calculation, is equal to I'll put it down here because I'm running out of space. It's equal to £45,720 and 74 pence. Okay, so that's all you've really made is £45,720 and 74 pence over that 10-year period after buying it, renting it out, achieving the capital growth, selling it and dying. That's all you made over that 10-year period. But here's where it gets like really powerful, right? Because remember, the original salary that we had was £100,000. That's what we earned. Now, to get that gross salary back, that 100K, we invested in a property. We invested over 10 years. We made this money, paid all the taxes. We're really not left with much, because look at this. If you think that you started with £65,000 and you plus the gain here of 45, 720 and 74 pence, you end up with a figure that's going to be the same as what I just showed you of 110,720. But if you take the 110,720, 74, and you minus off the 100,000 that you started with at gross, if you really think about that, by the time you've paid all of your taxes, you're only left with £10,720.74 profit over a 10-year period. You see, you initially had 10 years ago £100,000 that you earned in that year. You invested in a buy-to-let property, you sold it, you paid all your taxes, you collected the income, and at the end of it, that original 100,000 after all of the taxes in 10 years is only worth 110. If you think about it, without tax, you've only made £10,000 on the initial 100,000 that you earned. And that is why you stay trapped, because you're not making profit. The tax system is designed that says, hey, you've got to work 10 years. You've got to go through a 10-year cycle of investing and being shrewd to actually get that original £100,000 back after us taxing you all these times. But look at this. Now, if you look at what the tax man earned over this 10-year period, he's the one who won. He had income tax of £34,401, which, remember, when we made the £100,000 salary in our corporate job for that year, the tax man charged us £34,401. He took that. The second tax that the tax man took was £6,750 over that 10-year period on the initial day we bought the property. The third payment that the taxman had was over the 10 years was he collected £3,206.25. The fourth tax that the taxman collected from us was the corporation tax when we sold it of £26,885.19. And the fifth tax that the taxman collected was the inheritance tax, and he took £73,813.82 from us at that point. If you add all of these figures together, the taxman over that 10-year period, from our work, from our blood, sweat and tears, from our hard endeavours, the taxman made £145,056.26. We just made 10,000. If we think about the gross income of 100k, we only made 110,720 back. Minus that difference is 10,724. After you've been through that whole process, brought a property, collected the income, left it for 10 years, had the gain, sold it, died, we only made 10,000 over that 10-year period. The tax man has won. The tax man has took 145,000 from you without you really knowing, because nobody really does this calculation and breaks it down. Without you really knowing, you know you've paid tax, you know you've paid a lot of it, but he's actually just ripped you off. Royally ripped you off. And this is why I feel so passionate about the UK tax system. Is set up and designed to keep you under their control. They don't want you to get rich. They don't want you to be financially independent. They don't want you to be a 1%er and get wealthy, because they want to control you. Because if they didn't want to control you, why are they screwing you over with 5 times of taxes to give you this calculation where they take 145,000 but you take just 10,000 back? Now, of course, there are many things that we could have done at each stage to offset our taxes, which a shrewd investor would have done. One of those things might be have a family investment company, and the asset when it's sold goes into the family estate with a discretionary trust, so you pay £0 of inheritance tax right at that point. There's a number of things you can do, but hopefully this helps you to understand that if you just go about everyday life and you accept to pay tax and you don't think laterally and you don't think deep into financial literacy or learn financial education, you're not going to keep much of your money. And that is the problem that everyday people face, honestly, and is why 99% of people stay working in the lane of the middle class and don't actually end up becoming wealthy or financially independent. They go through groundhog every single day on the hamster wheel thinking, I'm working really hard, I'm doing the best I can with the tools that I have available to me, and I'm paying the tax, I'm being a good citizen, I'm still not getting to the place I want to get to. And it's honestly because the tax system is designed to keep it that way, to benefit them and not you. So my passion is to make sure and spread the word to as many people as I can to get yourself financially educated. Learn financial literacy. It's the number one thing that I promise you is going to give you an infinite return on your investment, and it's going to make you a lot of money, right? Now, I don't have time in this video to go through all of the ways, strategies, systems that we use and teach to offset this, but all I can tell you from a high level is that myself, my clients, in the right scenario, never pay taxes on our property investments, or minimal taxes, legitimately above board as a UK resident. Okay, I've just declared myself non-resident. I've moved to Dubai. If you've been following my work for a while, you'll see I've done that. But it wasn't for the property investment side of the business, right? That is, I never pay tax on, and I will never pay tax on with what I do, and I'm going to share that structure with you. And if you want to work closely with me, there's a few spots that have come open in my program, Property Investors Accelerator, and our higher offer Property Quantum, where I work with you closely to show you the advanced tax strategies that wealthy property investors are using to keep more of their money and to pay things like £0 in inheritance tax, and to not be liable to capital gains tax on sales and things like this, and to draw income out of a limited company tax-free using directors' loans accounts. I show you a number of ways of how to do that. So if you're interested and this video has enlightened you and you found it useful, not only click the like button, but in the link below, you can schedule a call and you can book in with my team to have a sales consultation to see if we're a fit to work together. And if we are, great, we'll do business, we'll get on, and I'll save you a ton of money, and I'll show you how myself and my clients invest with really little to no taxes. And equally, if you just like this video, you found it useful, but you're not in the right place right now to invest, or you don't think that working with somebody is what you want to do right now, that's also fair enough. No problems at all. I hope this worked for you, and I hope you found it useful. I hope it gave you some insights into new things and new ways of thinking that you didn't know. And if anything, I hope it wakes you up. So if it woke you up, please, again, click the like button, subscribe, click on the notifications bell, drop me a comment in the section below. Let me know what you thought. Apart from the dark background, like I say, I apologize for that. The lighting's not the best today, but like I say, hopefully it doesn't matter about the wrapper. It's about the content in the wrapper, and hopefully you found this valuable, right? Now, just to finally finish, like, I really want to spread the word as much as I can. Like, honestly, I fundamentally don't mind paying taxes, even though it sounds from this video like I want to avoid everything. I don't. I want to pay as little taxes as I can, because I don't believe that the UK tax system is set up to serve what it's supposed to do. And I don't mind paying reasonable taxes, but this just is unreasonable. If we look at this calculation, I think everybody watching this video would say to me, Rich has a fair point. This is unreasonable. It's unfair taxes that we're paying, and we're actually being ripped off. So I want to spread this and share this video to as many people as I can. So if you liked it, again, click the like button, but also share this. Share this video, post it on your own Facebook, because or any social media platform. Just share it wherever you can, because I want as many people to see this calculation as possible to really understand just how the UK tax system keeps you trapped. Listen, you've been great. Thank you so much for watching my video. If you want to work with me, I look forward to working with you soon. And again, thanks so much for your time. Appreciate it. I'll see you in the next one.